That was a week ago. I thought you were very bearish when you were on, right? And
well, I said sell FANG. That's what I said.
Well, also you didn't see much upside at all.
Yeah,
in US.
2,900.
So, right. So we're 1,000 points higher on the Dow since that was fast money, I think, last week.
Yes, it was.
You doubling down on the bearishness, or
no?
Was that...
You know what? I'm sticking to 2,900 for our year-end target, which is basically where we are right now.
Right.
I think the problem is the market never flatlines. It either goes up a lot or down a lot. So I guess if I had to bet on the trajectory of the market from here, I would bet on upside risk rather than downside risk. Yeah. I think because you've got an accommodative Fed, you've got, so here's the thing. I think we're underestimating the positives from this so-called trade war we're having. Because, what's not priced into the market is the potential economic boost from moving companies back to the U.S., from actually bringing jobs back to the U.S. I think those aspects of economic growth aren't necessarily priced into the market. What is priced in is margin pressure, rising input costs, lower exports. So I feel like the market is discounting more of the negatives and less of the positives. The one thing that I find really weird about the S&P 500 right now is that it's gone up a lot, but what's led the market has been more defensive, kind of safe haven areas. So it's not necessarily the normal bull run that we're used to in an equity market. It's been led by utilities and, all of these sort of low beta, safe, defensive hedges. And I think what could actually happen as we move through year end is that cyclicals could actually take leadership. So I'm a big fan of cyclicals. I think, buy or sell the market, I guess buy rather than sell. But from here, I think the real money is going to be made by playing sector rotation.
If tariffs do escalate, presumably the market would fall in the short term. Are you saying this is a potential long-term benefit?
Yes, exactly. So I think you're right. Timing is everything, and probably the positives will take a longer time to percolate. And in the meantime, we might see a little bit of fallout from global supply chain disruption, et cetera. But, I think if you take the long view on equities, it's like you've got a super accommodative Fed. You've got U.S. corporations continuing to make money. Margins haven't necessarily collapsed, even though costs have increased a little bit. So that suggests that companies are starting to exert some pricing power. And our economists don't see a recession for another year and a half or more.
How important is the Fed in that entire equation?
I think the Fed is actually pretty critical. So if you notice, the markets actually rebounded once the Fed came back and said, we're going to, again, whatever it takes.
Same thing in December. Every time the market turns and pivots.
I know, exactly. So they're basically the arbiter of whether the market goes up or down. And so they're critical in this whole bull market. And they've been basically the backstop for the bull market since 2009. I think that where we are now, though, if we start to see growth improve in the second half, let's say some of this tariff madness calms down a little bit and we start to see improving economic trends. We start to see companies spending a little bit more on CapEx. They're starting to plan a little bit. That could actually keep the Fed on hold, but growth could drive the market higher from here. So I do think the Fed is important, and their signaling mechanisms are probably the most critical voice in the market right now.
Would you buy any stocks in China right now?
So I'm a big fan of U.S. tech. I think China tech looks troubled. Because the problem is, I don't see China stopping the purchase of U.S. semiconductors. They buy our chips for $1, and then they sell the finished goods for $4. So the demand for U.S. goods, I think, it's hard to argue that they're going to stop importing semiconductors from the U.S. I do think that China relies on the U.S. more than the U.S. relies on China. So I'm not necessarily ready to step in and buy.
You like U.S. tech, but didn't you say sell FANG? So
I do. So I think that U.S. tech, like if you look at software, security stocks, those are the places you want to be. Software has crushed it for most of this year. Semis, I think they look better than China, but FANG is the area where I worry the most about because these are super crowded stocks. They've generally led the market for the last 3 or 4 years. And the regulatory risk around these companies is starting to ebb up. So you've got monopolistic issues rearing for a couple of these companies. You've got corporate governance issues starting to show up. You've got data privacy. Like, this is a sector that has had a regulatory free ride forever, and now all of a sudden it's in the crosshairs of the regulators. So I think that that's the key risk for FANG. It's not about China. It's more about what's happening in the U.S. from a regulatory standpoint.
If you were to do a Ben, you know what a Ben Franklin close is? You know what that is? That in the brokerage business, you would be talking to a client, you'd say, draw a line down the center and put the positives and then put the negatives, and then you count them up, and then that's how you make a decision. You do one or the other. I just think, interest rates are so low right now. I mean, people, you can get 4% in a stock. I don't know what the average yield is on a stock, but it's higher than on the 10-year. That's just such a simple, there is no alternative.
Stocks are the best game in town. You know what, though? There is an alternative. You know what the alternative might be? Cash.
Cash might be alternative, but I'm not sure that's great either.
Even in low inflation, your cash is losing money over time.
If there's no recession right now, and I don't know whether there is or not, maybe you're seeing some slowing of it, but there's all these positive things globally that you might look at globally, and then you even look at sentiment, which I think is still negative. People hate it.
I agree.
Do you know the market is back to where it was in January of 2018? So what month is it? It's June, isn't it?
Yeah.
Is that a year and a half that we've been in this rolling sort of a consolidation of those big gains following the election? We've made no headway, and only since 1999, only a 4% annual return.
But at the same time, the 10-year is lower than it was when the Fed started hiking rates.
I worry about
in December 2015.
I worry about the law of diminishing returns with the Fed.
That does suggest.
I don't think they can do it for us anymore, but I think we always wanted the Fed to hand the baton off to the underlying economy. Now, we've got 1 year of 3%, basically. We've got a quarter of 3%, and everybody, once again, is saying we're going down to 1% in the second quarter. Maybe we do.
But on the law of diminishing returns and the idea that there is no alternative, you look around the rest of the developed world, and central banks really have the law of diminishing returns there if the ECB is going to ease again. So again, it kind of brings you back. You
can't go out of the 10-year into the German boom.
But that is an argument of a relative attraction as opposed to necessarily absolute attraction.
Everything in life is relative. Yeah.
I don't know. I certainly don't feel, maybe we are too complacent, but I certainly don't think we're, rip-roaring bullish. No one's got a 3,500 target on the S&P.
We're not at euphoric levels that typically.
No one's got a 3,300 target on the S&P.
You're right.
That's 10. That's 12.